Alright, let's go over this here quiz and see what we got. Let's go over the first problem. Question is how much to book up the revaluation of asset values inside before the bringing in of a new partner. And so let's see what we got here. First of all, we have to figure out what our book up's going to be. The problem tells us, I won't go through the exact words, but the problem tells us that we're going to book up land by 100. Inventory by 50. If you look at the problem, you'll see that that's what it's telling us. For example, inventory is really worth 175. That's 25 more than it is. They tell us that there's goodwill of 30, so we're going to add that to the book up. That's it. That total is 180. So now we're going to divide the 180 according to the original partner's capital ratios, equity ratios. 20% of the 180 is 36,000. We're starting with a 20%. We got a 30% and a 50% to go. 20% of 180 is 36. 30% is 54. 50% is 90. That would be how we book up according to LMN, lemon, mango, and knob. The answer becomes D, which there is a D, doing exactly what we just did. How much cash must Oren invest to acquire 1/5 interest? So the book up puts us at a total value of this plus 180. So let's see what that is. 1025 plus the 180. The book up will give us our capital accounts. $12055, and Oren wants to be a 1/5 interest, so that means that this would be worth 80%. 80% of that will give you an implied value of some number. 20% of that will be Oren's share, and it's going to turn out to be, of the choices here, it's going to turn out to be this number, 301,250 at the end of the day. And you can do the math to figure it out, and that's what it'll be. Then we have and let's just do one thing here. Let's just double check that. Yeah, okay. Just want to make sure I have the right math. Then we have to do number 3, which is what's the ratio of the new owners when they get together? What will be the new ratio? And so what you're going to wind up doing is the following. Here's how I approach this problem. We had a 20% guy, we had a 30% guy, and a 50%. At the end of the day, we're going to bring in a 20% new partner. And so in order to bring in a 20% new partner, we're going to have to take from each one of these guys a certain amount in order to make it work out. So in order to take the right amount out, you take it in proportion to the proportionate that way they share, which is 235, so to speak. That means that what happens with 20% guy, he'll give up 4%, go to 16. This guy will give up 6%, go to 24. This guy will give up 10% and go to 40. That leaves us with just enough to bring in a credit balance of 20. And of course, that's not the way you balance it. This is what they will become. The entry will be based on how you get it, how you reduce it. So it's 4, 6, 10. That's 20. And these are your debits to the capital accounts. This is your credit to the capital account, bringing in the new guy at 20%. So this really is the entry right there. This is what the results in the original partners, and this ratio becomes, if you just do the ratio of the math, 4, 6, 10, I should add this to it, and that's, I'm sorry, not that number, but 5. That's the ratio that becomes the ratio of the new partners, which will be 16, 24, 40, and 20. That adds up to 100. To get to 20, you're taking away from all these guys, End of story. Alright, so this problem here, the next one, the weighted average we skipped. If you did it, the answer was C. And you can go back and see how you might want to do that or get to that number. What happens in number 5 is we want to know if the average capital accounts are these, what happens to allocate the salary. The salary is given to us as 40 and 60 here and here. So we know we have the salary, and then it's 10% return on capital. So 10% return on capital is 22.4 and 23.8. That's the 10% of those numbers. So that gives you, let's see, let's do the math. Should have brought a calculator here. I am just too lazy right now. Besides which, it's good to see if you can still do things by hand once in a while. So that's 646. Going to add 100 to it for the salary. 146.2. The answer is going to be C. Correct answer. Number 6. So all we did there is we just showed how much is total salary and interest based on the agreement. All these problems are just sort of doing is asking you to read the agreement. It's 10% interest on the average, and this is the salary amount. Just read the agreement. Same thing with number 6. It's based on the agreement. These are the average capital account balance. What will be the total partnership profit allocations for Bertram and Ernest? The profit allocations, and that would be based on the total profit is 240. 240 is the total profit. So we're going after how are we going to allocate that? Well, we're going to get 10% here, 10% there. That's 24. And of course this is Ernest. So put E down there. 20,000 here. That's Bert. Salaries are 40 to Bert. So let's just do Bert. 40 to Bert. Salary. That gives him 60. Now we'll do 60 here because that's Ernest's salary. That gives us 84,000 to Ernest so far. Over here we've got 60 going to Bert. The total of those two together is, I might as well not do it by hand, let's do it 144. Total income is 240, so that leaves 96 to go. That's 48 because it's half and half. Half goes to Bert, half goes to Ernest. Over here means that's 108. Add to Bert's share, which is, turns out to be 80, Ernie's share, I'm sorry, 84. Add the 48 to him, which is his share of the profit. And that's going to yield 12, 9, 13, 132. And that answer will be D. That becomes their total distributions, which is consist of salary, interest, and then profit. All right, number 7. This is what we've spent some time in class learning. If the partnership agrees, provides a formula. One of the beauties of partnership workings is that if the partnership agreement provides a formula for the computation of a bonus, the bonus would be computed according to whatever we want it to be. D. That's, again, if you're not sure of that, go back to the text, take a look there, but that's the beauty of partnership accounting and dealing with partnerships. Number 8, if the sale of U.S. company, we're in the foreign currency. Okay, let's see what we do here. If a sale and account by a U.S. company is made with a foreign company and the U.S. company has no risk, it must mean that, and the key here was the word denominated, that the transaction is denominated in U.S. dollars, so there's no risk run by the American company. And we've got, this question was, based what entry is going to be made of these entries? Well, if you go through, you would say the date the goods are ordered is not a date that we make any accounting entry. It's just an order date. Remember, this is looking at it from the purchaser, U.S. company purchaser. They will recognize it when they receive the goods. When they receive the goods, this is the exchange rate, multiplying the exchange rate times this number. The number 1 gives you this, and it indeed is a credit to accounts payable that we'll be looking for, and that answered the question right there. Fair value hedge differs from a cash flow hedge because the fair value hedge is the one where the ups and downs, the gains and losses, go directly to the earnings of the company. Answer B. And then finally, on number 11, how we do the translation into the functional currency. I might be using the word, well, they do use the word translating into the functional currency. Oh, that's why. Hey, that's good. That's good. Okay, so we called the, if we had to go from a foreign currency, we'll call it FOR period, to the functional currency, that's called a remeasurement. That's why I was searching for the words. So this is a little repeat of what we did in class. That's a remeasurement. And then if we go from the functional to the reporting, which might be a different currency altogether, that's what's known as a translation. And indeed, that's what the problem is telling us, that we've got a functional currency of Canadian, and we're translating it for reporting purposes into the US dollar. So in the translation, if you look at the what's known as the, well, in this case it could be either what we call the current rate method or the temporal method. Here it would really be the temporal method because it's a translation. The temporal method would be here. I'm sorry, the current method would be here. And this is going to be the temporal method. And if you look in your book, they show you what various accounts get translated at. Turns out to be that it doesn't matter whether it's current or temporal. The one account of all these accounts that always gets translated as historical exchange rates is the capital account. Just look in your book for that chart. And that is that.